Okay, welcome to another episode of Ridiculous. So yesterday we were looking at Algoma Central, which is the shipping company. They do shipping along the Great Lakes. So they got boats, they ship iron ore, coal, grain, all kinds of stuff. And yesterday we we sort of concluded that it's kind of historically it's okay. They did about um, they compound roughly 10% per year. Cost of equity, they should have earned it if the multiple didn't compress because they basically doubled their net income over 10 years. And you also get dividends. So you get about a 7% compound annual growth in net income, get some dividends. You should have been able to get 10% if their earnings multiple didn't decline, but it did. So they so it hasn't worked out super fantastic for holders in any event. The I guess the main question now is what to do, right? So this is the hard part. It's an industry that it is not amazing, but it's also not going anywhere. Like if you really need to move corn from one part of Canada, US to the other side, Great Lakes are a pretty low cost way to do it. They also have these joint ventures in other parts outside the Great Lakes that are actually starting to produce some good profits, and this all might be temporary. It looks like both the JVs and Algoma themselves, since 2021, those profits have really, really shot up, really expanded. So I think it's worthwhile to take a close look at what's causing that, right? Like why have profits gone up substantially in the last 3 years? Is it pricing? Because it's probably not volume. They're already the sort of carrier of choice. They're already one of the largest. They're the largest Canadian shipper. Doesn't mean they're the largest U.S., but certainly they carry. They're one of the bigger players in the Great Lakes, and then it's just a matter of saying, well, what what can I do beyond that, right? From a cash flow perspective, like we looked at, you look at how much they generate from operations. They basically invested 100% into capex over time. So over time, they basically took all the money they made from the business and dumped it all into new ships, new capex, which includes sort of refurbishment and changing boats and blah blah blah. At least that's what it looks like. And they also have these joint ventures where they're expanding, so they're investing in, these JVs as well. And those JVs are not, again, over the same 10-year period, they put in also around 200 million. So in addition to all the capex, they also pumped in about 200 million to these joint ventures. They got about 90, they got 300 total, and they got about 90 back. So um, they do have ships around the world, different parts of the world, or at least they have. They're saying they have 84 vessels and 13 under construction. So close to 100 ships. It was at the end of 2022. And yeah, so looking at the 2022 annual report, we'll need to read. It's tough to read and talk at the same time. Walk and chew bubblegum, but we'll do our best. Yeah, so see some of the ships there simply replacing old ships. So I said in February 2023, we announced the Algoma and the CSL Group, it's one of their pool partners, who together formed the CSI International Pool, placed a new build order to construct 4 new methanol-ready CAM-SAR-Max-based ocean belt self-unloaders. Wow, that is a mouthful. These new ships will replace the pool's oldest vessels and become the model of its next generation vessels. They're expected to be 40% more efficient than the ships they're replacing. So that's like an interesting point, but it doesn't really help you as an investor. Like 40% more efficient. So what does that mean? Cost go down 40%, can they carry 40% more tonnage? Is it right? Like, what's the actual effect of that going to be? It's not very specific. It sounds like it's better. It sounds good, but you really can't do anything with that at the moment, unless you know more specifically. You can assume, but that's probably a bad idea. So yes, some of that capex is really just replacing old ships with newer, better ships that run maybe more fuel efficient, lower cost, maybe they carry more tonnage. So essentially lowering the cost per ton, making better margins, all that kind of stuff. Yeah, so they're also the average fleet age has come down since 2013, where it was like 30 years. I guess that's years. So just like there's just a number, but I assume that's years. So 2013, the average age of the ship was 30 years, and then by 2023, it's like maybe 16 years, so about half. So all that capex has gone into not only just maybe more boats. We'll have to take a look. but also replacing older ships. So you get the average age down of the amount of ships that they're doing. And that's good. It means that if these things last 30 years, then it's a lot of trading that you can do. You got a lot of time to sort of earn those boats out. Okay, guess that doesn't work. So what are they pitching? They're entering, so these partnerships, these JVs, diversify geographically, enter niche short sea markets, invest in asset class with high barriers to entry, and vary our exposure to underlying economic drivers. Okay. I'd like to understand more of the high barriers to entry. What is, you're buying a ship? What is that barrier other than money and operations? Cement carriers sound very specialized. So let's see, cement. I see. So this is back in 2017. Their cement carrier saying service large global manufacturers that support infrastructure investments. The fleet is now the second largest in the world. That was 2017. Managed short sea mini bulker fleet that comprises ships on 15 million tons annually support the agriculture cement. Okay. Hmm. Who is their partner? Nova Marine Carriers. It's a shipping service out of Switzerland. Okay. Does not tell me much. All right. So this is 2022. The global short sea shipping segment continued to benefit from strong global markets, particularly for cement carrier and handy-size bulker capacity. What is so special with cement carriers? What is so special about cement carrier ships? Well, this is part of the problem. I don't know what's magical about cement carriers, but it feels like it's a specialized piece of equipment essentially. And so you have manufacturers of cement need to ship that to infrastructure projects, large infrastructure projects, and you need to ship a specialized piece of equipment to do that. Therefore, you should, in theory, get stable margins. That would be a hypothesis. Let's double check that. We have to check that and actually see if that's true. That just might be made up. Domestic dry bulk performance. Utilization. Okay, so it's in the 90%. So normally navigation days, fine. Navigational season, normal being subjective. Yeah, so it looks like most of what they're moving is iron, steel, construction, which I assume is aggregates, agricultural, so grains, and then salt, and then a bunch of other stuff domestically, which is Canadian. So Canadian, remember they're Canadian, based in Canada, so domestic means Canada. Product tanker. Whoa. So product does liquid petroleum cargoes through the Great Lakes, St. Lawrence Seaway, and Atlantic Canada. 7 product tankers, Canadian flagged, 3 vessels operating under Anishinaabe flag. Okay. $120 million revenue, 10 million earnings. 2020 vessel utilization, 94% versus 2021, which was 82%. So obviously this can swing a lot. This has a big impact on revenue. Ocean self-unloaders. They have 8 ocean-going self-unloader vessels and a 25th% interest in a 9th. Okay. So these 8 are part of the world's largest pool of ocean-going self-unloaders, which at the end, so I guess rather than compete with each other, they just 100% utilization. Something about that seems off. I guess if they're part of the pool, put your ships in, everyone gets a slice of the business. And if you have, probably let you control a certain type of ship if it's required. How much revenue? About 200 million from this business, 44 million in earnings. That's a pretty good business. At least 2022 was a pretty good business. Revenue. It's gone up every year. What are they moving? Gypsum, coal, aggregates in the pool. That's in the pool. 25 million tons, 24 million tons, or thereabouts. Global short sea operational performance. I think we talked about this yesterday. Let's see. Okay, so for Canadian companies, there's a like Edgar in the US, there's Cedar in Canada. So let's see. Okay. Show the documents. Right. Oh, something came out literally today. Okay. What does this say? Okay, November 3rd is reporting results. Fine. So results come on November 3rd. For proxy management information circular. Yeah, so why are we looking at this company in the first place? Someone's wondering. It's because it appears cheap. Trading a discount to book. They do about 10% compounded, and they've grown their earnings by about 7% over the last 10 years, and dividends, not including special dividends, are about 5%. So you're getting about a 5% dividend, trading a discount to book value, and at least current earnings, you're getting, you're buying at 5 times earnings, 5.5, which is, still shipping, but if you can maintain that earning stream, that's pretty darn good. Right now, we're looking at the 2022 annual information form, which is a document you can find on their company on the CDAR uh, portal for Algoma. Ticker's ALC.TO, if anyone's wondering. Okay. So so there's four components to business: moving dry bulk along the Great Lakes and St. Lawrence seaways, moving essentially oil and gas along the same routes. Um, they have this ocean self unloaders in this pool. Those trade worldwide, and they have their cement business and short mini bulker fleet, and this handy size bulker is part of a sales and purchase platform. Okay, so they have like four big components to the business. The biggest, of course, is the domestic business, dry bulk, product tankers, the ocean self unloaders. Yeah. Yeah, so their reported revenue is is less than the actual, right. The first quarter is always bad, so there's seasonality because the Great Lakes and the St. Lawrence Waterway are closed for winter. Makes sense. It's Canada. And the majority of the domestic dry bulk fleet does not operate for most of the first quarter. Okay. So they do the repairs and maintenance in the first quarter. So you get a lot of cost and not a lot of revenue. And that seasonality is limited to the domestic dry bulk business. Okay. So there's maybe less fluctuation in the other businesses. Yeah, so they did a major refinancing in 2020, which is great. We talked about it yesterday. They basically have lots of room before they have to renew debt, which is great because they missed this entire interest rate kerfuffle. Okay, so this is interesting. The overwhelming majority of the company's revenue are a result of long-term contracts with large industrial customers, many of which have been customers for many years. Contracts typically have terms of 3 to 5 years and can have terms of 10 years or longer in some instances. Such contractual commitments result in the company dedicating vessel capacity to customers over a long period of time. Failure to renew a significant contract result in a reduction in revenue prevent. So this revenue is contracted. What does that mean? Does that mean they get okay? All right. So key things we need to figure out. Some key things we need to figure out. Key questions. Here we go. Key questions. 1. How do the contracts work specifically? Like these are contracted revenue, right? This is the majority. How much majority? 70%, 61%, 98%. So how much is contracted? Contracted revenue. So like maybe this contract. All right, let's see if we can. How do Algoma Central contracts work? Okay. Side note: Lakers are ships that designed to operate in the Great Lakes. And the average lifespan of a Laker is 40 to 50 years. So if they buy a new Laker, this thing can go like that's a long time because I guess it's fresh water, so there's no salt. Okay, good to know. But there's size constraints because obviously there's only so much room to go through the locks in the St. Lawrence Seaway and blah blah blah. So they can't go in the ocean. Okay, so salties, which are ships that can go visit the Great Lakes but also go in the ocean. They might carry lower cargoes on the lakes to compensate for the deeper ship draft, but then they get topped off before exiting the seaway. To layups. Mm-hmm. It's an interesting article. So yeah, Lakers and Salties, two main types of ships that trade on the Great Lakes. Okay. So what I'm trying to do is I'm trying to see if there's a recent, at least primer on how the contracts actually work. And it talks about how the ships and what types of ships and all this. How does the business work? Like I'm assuming it's you might price it because it's mostly bulk cargo. Price it per net ton, per ton between wherever it's got to go, obviously. But that's an assumption. I don't think it's unreasonable, but I prefer to know. Okay, shipping, transport rates on the Great Lakes. On the Great Lakes. Okay, let's take a look at this. Federal Reserve Bank of St. Louis, producer. Oh, interesting. Okay. Producer price industry, coastal and Great Lakes freight shipping transportation. I don't know what this magical index is telling me. Not season. Okay. What is this magic index? Transportation and warehousing. So does this mean prices have doubled, tripled since 91? Okay, great. Tells me nothing. Goodness sakes. Goodness sakes. Here we go. This might be something. Great Lakes St. Lawrence Seaway System. Schedule of tolls. What does this tell me? Price are $CAD per metric ton as otherwise specified. No, this is for tolls. For cargo. Right, that's what they pay. Still interesting. Bulk cargo, grain, coal. Okay. Basically tells you. Now this is good. Tonnage. Ooh, mama. So St. Lawrence Seaway Management Corporation gives you tonnage year to date. Only year to date. Come on, guys. Not even monthly. Goodness sakes. So you can actually see the tonnage. Okay, this is good data. They give you monthly back to 2020. Otherwise, in 2019, it's only annual. Fine. But you can see changes in tonnage overall back to 98. Great. We will get that. We will save this and make sure we can grab that data. That is good. Back to sheets. Traffic reports. What do these traffic reports do? Great Lawrence, St. Lawrence Seaway 2022 traffic report. So it's actually a lot of data. Probably a lot of data that is unnecessary. Okay, so what is this? Okay, so this traffic summary. So the site we're on is Great Lakes-Seaway.com. Great Lakes St. Lawrence Seaway System. Basically, these guys manage the whole seaway. It's government body. Tonnage and transits. So amount of vessel transits. Gross tonnage in by commodity, which is cool. General cargo, containers, grains, coal, bulk. Bulk, as previous years, includes domestic general and domestic steel slab. Okay. So you have steel slabs and you have domestic steel slab, which is in bulk. Revenue. Traffic revenue by toll classification. I guess these are tolls. Yeah, these are toll revenue. Summary of major commodities. Oh, okay, good. So you get tonnage by section. Okay. Wheat and soy and corn. Okay. Iron ore and coal and salt. Wow. There's a lot of salt moving along the seaway, a lot of iron ore, processed products. This is awesome. Hmm. Also interesting how many days they also give you days of navigation. So like how many days you can actually, right? That's that's probably relevant too for revenue. Just might not be, if you lose a week of shipping, you just lose revenue. That's it. There's nothing you can do about it. If it's unsafe for transport, it's unsafe for transport. Too bad. Traffic by class and type of vessel. Interesting from a competitive perspective, but maybe too granular for our purposes. Yeah, so you can see a lot of inbound out. So you see the inbound, outbound. So, like for example, traffic by 25 major Canadian ports. So Hamilton, 14% of all tonnage is inbound to Hamilton, and 13% of all outbound tonnage is Thunder Bay and Hamilton. So Hamilton's a major port. So what would you do with this information? What would you do? Why is that relevant, if anything? Inbound to Quebec as well, Montreal. Well, one thing that would be very relevant is if you had like some kind of natural disaster, storm or whatever. Like let's say there's a storm, and it's like, oh, Hamilton is under, some kind of whatever, some sort of storm. That shuts down the port. That's significantly more important from a revenue perspective than if it shuts down the Picton port or whatever, which is like 0.2%, or the Bruce Mines port, 0.1% outbound. Okay. So this is useful information to a certain extent. 25 major traffic major US ports. Cleveland, Detroit, and Toledo make 15% of total inbound. And wow, Superior, Toledo, and Two Harbors makes up 37%. So outbound traffic. So there's like strong concentration outbound. So same idea. So if you see, so let's say you were gonna look at this company and say, okay, what's important from this information? One of the things that's important in this information is to sort of keep an eye on these areas because you're moving physical goods. So you have natural disasters, you have strikes, you have protests, whatever, truckers strike, right? Because you still got to get the goods for outbound. You still got to get the goods to the port, and then for inbound, you still got to get the goods out of the port. Right? There's only so much storage capacity at the port itself. So if you have a ship that rolls up and the dock is full, or the storage areas are full for that particular type of commodity because the truckers are on strike or the railroads are on strike or whatever, then then you just can't either load or unload. But if it's Green Bay, they're striking Green Bay. Who cares if they're striking Cleveland, Detroit, or Toledo? You know, or Superior, makes a big difference, right? And they got upbound and downbound total cargo tonnage, which I think is relevant because I guess you'd pay as a shipper for each direction. I wonder how many. It'd be interesting to see if management, if they describe, if they do they have any bareboat, like just, you know, gotta get a ship from one side of the lake to the other, but you don't have any cargo to bring. You obviously you would never want to do that, but I wonder if that happens on the lakes. It feels like this market would be much more rational than ocean-going markets. Anyways, this traffic reports these are interesting data, and it goes back years and years and years. So something to study in more detail. If you get into it, you definitely want to look at that. Yeah. Okay. All right. So clearly you have contracted revenue. So you know you're going to have customers. How the revenue works is important. How the contracts work is important. And we're going back to looking at, we're going to go back and try to search through and see, can we get any contracts with customers that have been filed with the regulator, which is unlikely, but you only need one. So if you can see one, if you can find one and see it, then you're considerably ahead of the game in terms of understanding. It'll give you a clear understanding of what terms and conditions are, which matter. What is this other year in review? Nope. Don't need that. Yeah, so sometimes you need to do things that have like low odds of success, but if they succeed, they'll be great. Material contracts, credit agreements. Okay, so why don't we just search for material contracts? Can we do that? Is that a good idea? Maybe it's a bad idea. Material change report, other. Like, so you could be hiding in like an other. No, this is a no purchase agreement. Yeah, see, there's like, so the way things are like categorized is not easy to filter information, time consuming. Okay. And some information you might realistically only be able to ask management. They might not give it to you. So some information, if you can't find it, there's a limit, right? There's a limit to how much information you're going to get. So you got to be able to make judgments above and beyond that. Yeah, I don't expect them to have a customer contract just like in their filings, but I think it's worth a try. Won't take that long. Prospectus. No. Doesn't look like we're going to get lucky here, folks. contracts. Trust indenture. No. That's not what we need. Material contracts. Underwriting agreement. No. A whole slew of other. These are all credit agreements. Material documents. Purchase agreement. Okay, that didn't work. That's fine. Okay. Okay. There's a lot of also new marine legislation and regulations and stuff for climate change and stuff like that, and like emissions and all kind of environmental regulations coming in for shipping in general. And so that's going to impact obviously their operations and maybe increase costs. Hmm. Algomas typically operate as dry bulk vessels for domestically Canada for 40 or more years. It's international dry bulk for 30 years, and it's tankers for 25 years. At the vessel reaches the end of its economic life, the vessel company usually sells its vessels to qualified ship recyclers who will demolish the vessel and sell the materials covered with it. Ship recycling providers. Recent vessel sales recycles in Canada and Turkey. Okay, so that's good data. Dry bulk domestic. $40 international dry bulk. It's 30 years, and product tanker. And tankers are 25 years. Yeah, so when you buy a ship, you're going to use it for 25 to 50 years, depending on the ship. Hmm. So is there a way we can cut through this? Right? Is there a way we can cut through this? It will take a lot of research to figure out if this is even worth it. Hmm. Yeah, so hmm. Difficult. There's a lot of ground to figure out. Obviously, it's not in our wheelhouse in terms of obviously this is not our wheelhouse. Even if you can conceptualize a business, if you don't really understand how it works, where the risks are, where the opportunities are, and if it's not of a business where you can sort of rely on certain things to power it through, like a brand like Coca-Cola, you don't really need to know too much about specifics of the Coca-Cola, you know, bottler, necessarily the agreements, how they work in detail, because it's the brand, right? You're buying the brand, and they have pricing power. So you raise the price of Coca-Cola by 5 cents or 10 cents or whatever it is. People are gonna buy Coca-Cola. You raise the price of shipping per ton by 5 or 10 cents. By the way, we found an old paper. This is from '97, so take that for what it's worth. Great Lakes shipping pricing paper of the modes. This is 1997. Middle States Geographer, and it says today iron ore shipping on the Great Lakes can be identified. Blah blah blah. Prevailing rates for shipments from Superior Duluth to docks on Lake Erie range from $6 to $7.50 per net ton. By contract, vessel costs range from $5.75 to $7.25 per net ton. So, I mean, it's like 25 cents a ton that you're making. That's not a lot. Like, you got to ship a lot of tonnage. This is 1997, right? Like, keep in mind that's like 30 years ago or whatever, 20 years ago, almost 30 years ago. Yeah, 25 years or so. Yeah, so I wonder if there's another one of these studies available. If I can find out one of these studies. Yeah, so, like if you're operating on net margins, because really that's your business. Cost of running the ship versus revenue that you get. That's the whole business. If you're running on 25-cent margins, like you are not Coca-Cola. You are not able to raise that, a nickel, and it's outrageous, right? Conversely, if you get rates going up for whatever reason, that falls right to the bottom line. Economic study, Great Lakes St. Lawrence region. Oh, this is recent. July 23rd, economic impacts of maritime shipping in the Great Lakes St. Lawrence region. Now, this seems like more like an economic report, but put together by the Lake Carriers Association, so sounds like an industry group. Which means it'll be biased, but yeah, it looks like a U.S. lake shipping group. Okay. Let's see what they have here. So what we're looking for is really at this point, because it seems like right now it's okay. It seems okay. We don't want okay. We want good bets, right? We want great bets. Right now, this seems okay. It's cheap, producing reasonable, profits. There'll be some volatility, and the most important one is really our own ignorance. That's the thing. That's the biggest risk. We just don't know enough. If we knew enough, we could probably make a very quick decision. We don't. So this report looks to be it's an economic report. So basically, how much does the Great Lakes settlements contribute to the you know the regions? It's basically just that, how much cargo is being transferred, how much tonnage, how much jobs are supported, blah blah blah. It's useful, but not very in terms of our purposes. And which ports? Okay. How much tonnage is being moved? How much income support? Right. Yeah. Basically, it's talking about the impact of the Great Lakes and their study, like how much revenue essentially is it contributing to taxes. So it's an economic report. All right. I think this is. I'm just gonna flip through this quickly and see if this is actually useful in any way. So here's an interesting thing. So they have to estimate tonnage. Right, this is in a recent report. So it says currently there's no single source for the marine cargo moving on the Great Lakes and the St. Lawrence Seaway. In order to accurately capture the tonnage moving on the Great Lakes St. Lawrence waterway, an extensive data collection effort. The Chamber of Marine Commerce provided detailed port-to-port cargo movements by commodity carried on Canadian flag vessels. The Lake Carriers Association provides similar port-to-port movements by commodity and port for tonnage moved by U.S. flag carriers. International and Laker tonnage by commodity port was provided by St. Lawrence. International and Laker tonnage by commodity and port moving through the St. Lawrence Seaway was provided by the St. Lawrence Seaway Management Corporation. In addition, tonnage data provided by Port Marine Terminal was collected by Martin Associates from port authorities and private terminal operators. Provided was the only comprehensive database describing port-to-port cargo flows by commodity and flag for cargo operations on the waterway. So that's interesting. Basically, this study had to pull from these variety of different sources to get tonnage movements. So it looks like the St. Lawrence Seaway Management Corporation really just manages the locks and stuff on on the St. Lawrence, not necessarily the Great Lakes as well. So they don't have a comprehensive data set. There you go. So that's ignorance being revealed, right? Good. Right. Okay. So this thing is saying, so it's interesting, right? So it's like, you gotta think, it's like, okay, so this is saying in 2022, you got about 135 million metric tons of commodities that have moved along the Great Lakes and St. Lawrence Seaway system. 135 million metric tons. And that's worth in Canadian dollars about 34 billion. 34 billion. Steel, general cargo, iron ore is by far the vast majority, 40 million tons. And grain and stone. So 40 million iron ore, 30 million stone, 16.5 million grain. So grain, stone, and iron are you got to move by ship. By it's cheapest, probably the cheapest way to do it. You can't move by train. I mean, you could, but it's probably the cheapest way to do it. So these are raw commodities that got to be moved. People need, economies need them, so it's economically sensitive. It's going to be economically sensitive. Looks like there's 15 locks along the Great Lawrence Seaway, 7 between Montreal and Lake Ontario, and 8 locks in the Welland Canal. So 2 sections. What is this data? Oh my God, wait a minute. Okay, so this is Great Lakes. Okay. Great Lakes, St. Lawrence Seaway System, 135 million metric tons. Okay. And it also says, Jesus, so confusing. Great Lakes, St. Lawrence River waterway impacts, 250 million tons. Yeah, okay. Okay. So we think we can make a call on this. In general, the chances that our ignorance is high is very high. We just don't know enough about this business to make a good, informed decision. Now you can try to get that through study, and that might it'll take time. But then can you use the time for something else, right? Like if you invest the time here, you're sacrificing the investment of time elsewhere. So is this worth it? How do you determine if this is worth it? Is there a quick way to determine if this is worth it? It's not. It's like it feels like it's okay. What would make it worth it? That's a better question. Not what would make it worth it. What would make it worth it is if earnings are sustainable. That would make it worth it. If earnings can be sustained at this level, so that's what makes it worth it. Because the 25% discounted book is, whatever kind of. It's interesting, but it's not. It's not what we're interested in. It's not what we're interested in. Interesting, but not interested. Sort of. And the 5% dividend. I mean, that's in a world of 5% Treasury. Meh. That's sort of table stakes, I guess, at this point. Okay, so growth potential from new ships. There just might be too many variables that we do not know enough about, right? It's international JV business. Okay. The cost of Okay, so 2022 highlights. Most notably, customer demand in the product tanker segment has returned to pre-pandemic levels, following significantly reduced customer demand during 2021. Refinery output remained nearly full capacity through the year, and fleet benefited from cargoes delivered from the Great Lakes to the east coast of Canada. Okay. Stronger base freight rates in the domestic dry bulk segment offset slightly lower demand across several sectors, including iron, steel, salt, and ag. In ocean self-unloader, overall pool volumes continue to improve after pandemic-related cargo reductions. Aggregate volumes remain lower than years earlier. Tonnage remained steady throughout the year, particularly gypsum aggregate cargoes, partially offset by lower coal. Global short sea segment continued to benefit from strong global markets, including higher than normal freight rates. Increased revenues mainly driven by performance in the cement and handy-sized fleets. Reported higher gains from sales of vessels in the segment compared to 2021. Right, this handy-sized fleet is also this purchase and sale platform. Global short sea segment is able to take advantage of sales and purchase opportunities not available in other businesses. So they're actually trading of vessels. Fuel prices are passed through to customers in the form of fuel recovery revenues. Okay. So rising fuel prices are not terrible for shippers. Not ideal because it raises price for the customer, but it's not terrible. Yeah. Okay, so we are being enticed by low cost to book, being by the discounted book value, and by the low price earnings ratio. That's what's enticing us. But why do we want to be in this business otherwise? what did their financials look like in as far back as we can see? 2013. That's as far back as they see. Very different business. Yeah, so this is 2023 second quarter. The increase in revenue is being attributable to a 17% rise in volumes, leading to a 24% increase in revenue days and strong base freight rates. The large grain harvest in 2022 resulted in an increase in early 2023 grain shipments. Iron and steel volumes are up year-over-year, probably due to large export ore volumes that were contracted in 2022 for shipment this year. Early season demand for construction ag has been strong, probably driven by tightening of supply in the river class self-unloader market. As a result, the increased volumes, the fleet was fully utilized as compared to 2022, when 3 bulkers ran late due to lack of demand for grain and iron ore shipments. Okay. So, question: what happens if earnings drop to 50 million? Let's say earnings get cut in half, which sounds not historically unlikely, but also the business is different. These JVs are adding a lot more earnings power. Right? That bad 2020, 2019, 2020, but otherwise the JVs have produced. They invested 300 million since 2016, and it's produced 84 million in earnings, 90 million in cash flow. So 2, 3, 4, 5, 6, 7, 8. That's 8 years, most of which come in the last 3 years. Virtually all of it in the last 3 years. Outlook. Typical seasonal weakness in grain shipments and a soft market for export iron ore has led to a brief summer layoff of one bulker. Full fleet utilization is expected to resume in August and continue through the balance of the year for a strong demand for vessel capacity late in the third quarter. Recent weather conditions result in some concern about 2023 grain harvest. However, demand in other sectors appear to offset any weakness in agricultural products. Yeah, so as a business, you are beholden to volumes from customers. That's the practical reality. If you don't harvest enough grain, you don't ship grain. If you need less iron or steel, you sell less, you ship less. Hmm. All right, I think we think this one bears watching, but not further study. If it got to the point of like being really cheap, half book value or something like that, then we'd take a look. Where it's like it has to be so cheap that you can't avoid looking at it. Right now, Debt structure looks good. Hmm. Yeah. Basically, it's not strongly exciting enough for us. There's might be some, if you really understood this business, you could probably have a different view. But for us, it's the amount of work to get underneath the revenue earnings is too high for a single like there's one public I think there's one public company trading on the Great Lakes, if at most, maybe a couple, two. So you're gonna do all this work to buy into a business that's, you know, arguably so, right? It's not like, again, it's a shipping, it's a transportation business, and then at the most you can buy one of them. Yeah, yeah, it's like very specialized knowledge. Like it's interesting, but you won't be able to translate that into, something else, unless you're going to look at ocean going vessels, which is an even harder game to play. Like this, at least, you know, it's a pretty well contained environment. Like if you're major, it's the major player on the Great Lakes, or one of the major players, right? So you're going to get, you know, if you're if you're trying to serve a customer, let's say a customer has, you know, 100,000 tons of grain, and they don't want to deal with 40 different operators. They prefer to deal with one that can handle the business. It's easier. So there's an advantage to being big. On top of that, you're going to get higher operating costs. Right, like the striving for higher wages. Yeah, all right. I think we're gonna cut it here. Doesn't seem like there's. It doesn't seem like it's worth the effort. That's the short answer. It would be very interesting to do, but not very profitable to do necessarily. So, what do we draw our conclusion from? It's very specialized, not necessarily cheap enough, and costs are going up due to both inflation and things like this strike. If they impose new costs on the operators, they're going to have to flow through the supply chain eventually. And then you have the overall So let's just, okay, so they carried total cargo carried per metric tons. 2022 is 43,560. This dry bulk, domestic product, and ocean self-unloader. And revenue for those three segments is what? So 43,560. Okay. $15,000 a ton. Domestic dry bulk. Is this the right way to look at it? So it's 36 million, $360 million revenue and thousands of metric tons. Okay, so it's thousands of, so 19 million, 280. Yeah, so you're talking $18 a ton, $19 a ton. This is 2022 domestic dry bulk, 1862. Let's see, 2021. $16 a ton. In 2022. $14 a ton. So that extra $4 a ton has basically powered, like, from 2020 to 2022, total volumes, domestic dry bulk, which is their biggest segment, was flat. Down 20 million in 2022, 20 million total metric tons shipped in 2022. This is combined. And in 2022, 19.3 million. So tonnage is actually down over the last 2 years, but revenue is up. So they're getting much higher rate per ton. How much of that is fuel recovery? Because some of that's going to be fuel recoveries, right? Higher gas just flows into revenue. Depending on the accounting, unless they do a net, but let's assume it's into revenue. Yep. Their contract terms provide for a rate adjustment to offset the effects of inflation. Expect freight rates to rise in 2023. Okay, so they have contractual rate adjustments for inflation. Yeah, same thing. 2022, and for the product tankers, so for the oil and gas stuff, basically you have a slight increase in volume. That's $50 a ton. Yeah, so rates are slightly down, but Ocean self-unloaders. Basically flat volumes last 3 years. Wow. But rates are sky high. $2020, $6 a ton. 2022, $9 a ton. 50% increase in prices. Okay, so basically, if this okay, so the real question is, if we're going to ask one question, to management, it's what's the key most, what is driving the increase in rates over the last 3 years? Question mark. That's it. If we wanted to look more at this, we'd want to figure out that one question first. What's driving the rate increase? How much is that coming from? If we could figure that out, and if that's sustainable, then you might have something. Like, depends on what's driving that, right? If competitors have dropped out of the market, if whatever, something is driving that. So what's driving that? If it's just contractual inflation and they're just sort of ahead of, and they got ahead, then that's a separate issue, because that's not. But if something's sustaining within, at least within the control, then you might have something to consider. But otherwise, it looks like most of the performance is almost entirely, at least on the revenue side, is entirely due to price, because volumes are basically flat, if not slightly down. If not slightly down. Yeah, and then short sea shipping, again, they're not even sharing the tonnage there. Okay, so that's what we'll do. That's what we'll do. That's what we'll do. We'll see if we can contact management and ask and talk about pricing. If that doesn't work, then we'll move on. And if there's something there, it could be worth looking. Yeah, because at the moment it's okay. It looks okay. That's about as much as we can say. But otherwise, it's yeah. Plus, you have an overhang of shares also too. That's a separate issue. All right. That's the deal. We're gonna try to see if we can contact management and ask them what is the deal with pricing. This Great Lakes, the strike on the Seaway. He's estimating that Algoma is losing $1 million a day in sales. $1 million a day. Phew. Wow, that is going to screw up the fourth quarter. Wow. All right, we're going to see if we can. There is no. Okay. Okay, that's it for today. Thanks for watching us fumble along. And that's what we're going to do. We're going to see if we can contact management and get them to talk a little bit about kind of what's driving their increase in rates. Obviously, the this strike is going to be temporary in nature. They're eventually going to open up but it's going to cost them a lot of money fourth quarter. So, but the more important question is these profits that they're seeing, which are pretty healthy in the last couple of years. That seems like entirely due to rate. So the question is, why are rates going up, and are they going to stay up? If they're going to stay up, and it's not going to be met by commensurate substantial increase in costs, then it's looking pretty good. It's looking pretty cheap. But if we can't determine that reasonably and with a clear margin of safety, given our ignorance in the industry, then we'll move on. Thanks, everyone. Talk to you later.